Stock split. A stock split occurs when a company increases the number of its shares by issuing more to current shareholders, while proportionally reducing the price per share. For example, in a 2-for-1 split, shareholders receive 2 shares for every one they hold, and the share price is halved. The overall market value of their holdings remains unchanged. Reverse stock split. A reverse stock split reduces the number of a company's outstanding shares while increasing the price per share proportionally. For example, in a 1-for-10 reverse split, shareholders receive 1 share for every 10 they own, and the price per share increases by 10 times. Companies often do this to meet minimum share price requirements for stock exchanges. Rights issue. A rights issue is when a company offers existing shareholders the right to purchase additional shares at a discounted price before offering them to the public. It is often used to raise capital for debt repayment, expansion, or other corporate needs. Buyback, share repurchase. A buyback is when a company purchases its own shares from the open market, reducing the number of shares available. This can increase earnings per share, EPS, and often signals that management believes the stock is undervalued. If you're finding these finance concepts starting to click, hit that like button. It really helps the channel grow. And subscribe so you don't miss the next video, where we break down how to actually build your first investment portfolio. Forex, foreign exchange. Forex refers to the global marketplace for trading national currencies against one another. It is the largest financial market in the world, operating 24 hours a day. Traders profit by predicting whether one currency will rise or fall in value relative to another. Portfolio. A portfolio is the collection of all the investments an individual or institution holds. This may include stocks, bonds, commodities, cash, and other assets. The composition of a portfolio reflects the investor's goals, risk tolerance, and investment strategy. Holdings. Holdings are the specific assets within a portfolio. For example, if your portfolio contains 100 shares of Apple, 50 shares of Microsoft, and government bonds, those are your holdings. Interest. Interest is the cost of borrowing money or the return earned on lending money. When you borrow funds, you repay the principal plus interest, an extra amount calculated as a percentage of the loan. When you lend money, such as by depositing funds in a bank account or buying bonds, you earn interest from the borrower. Bond. A bond is a fixed income security representing a loan made by an investor to a borrower, typically a corporation or government. The borrower promises to repay the principal at maturity and pay periodic interest, known as coupon payments, until then. Security. A security is a tradable financial instrument that holds some type of monetary value. Common types include stocks, representing ownership in a company, and bonds, representing a loan to a company or government. Securities can be bought, sold, or exchanged in financial markets and are regulated to protect investors. Broker. A broker is an individual or firm that facilitates buying and selling of securities on behalf of investors. Because individual investors cannot directly trade on most stock exchanges, brokers act as intermediaries. In the past, brokers often worked in person or over the phone. Today, most operate as online trading platforms, charging commissions or fees for each transaction. Going long. Going long means buying a stock or other asset with the expectation that its price will rise. The investor plans to sell it later at a higher price to make a profit. It's the opposite of shorting a stock. Asset. An asset is anything of value owned by a person or organization that can provide a future economic benefit. Assets can be tangible, such as real estate, machinery, or inventory, or intangible, such as patents, trademarks, or goodwill. In the stock market context, assets also include financial instruments like stocks, bonds, and cash. Commodity. A commodity is a basic good that is interchangeable with other goods of the same type, regardless of who produces it. Common examples include oil, gold, wheat, and natural gas. Commodities are often raw materials used in the production of other goods and can be traded on specialized markets. Yield. Yield is the income generated by an investment over a specific period, expressed as a percentage of its cost or market value. For example, a stock that pays $5 per year in dividends and costs $100 per share has a yield of 5%. Yields can come from dividends, interest payments, or other cash flows. P/E ratio, price to earnings ratio. The P/E ratio is a valuation tool used to compare a company's stock price to its earnings per share, EPS. It helps investors determine whether a stock is overvalued or undervalued compared to its earnings. A high P/E can mean investors expect higher future growth, while a low P/E can indicate the opposite. However, P/E ratios must be interpreted carefully because past or projected earnings are not guaranteed. Dividend yield. Dividend yield is the annual dividend payment per share divided by the current share price, expressed as a percentage. It allows investors to compare income potential between dividend-paying stocks. Beta. Beta measures a stock's volatility compared to the overall market, which has a beta of 1.0. A beta above 1 means the stock is more volatile than the market, while a beta below 1 means it is less volatile. Alpha. Alpha measures the excess return of an investment relative to the return of a benchmark index. A positive alpha indicates the investment has outperformed its benchmark, while a negative alpha indicates underperformance. PEG ratio, price to earnings to growth. The PEG ratio is the price to earnings PE ratio divided by the company's expected earnings growth rate. It adjusts the PE ratio for growth, helping investors assess whether a stock's price is justified by its growth prospects. Index. An index measures the performance of a group of assets, typically stocks, to represent a segment of the market. For example, the S&P 500 index tracks the performance of 500 large U.S. companies. Indexes are used as benchmarks to gauge the overall direction of the market or specific sectors. Futures. Futures are contracts that require the buyer to purchase or the seller to sell an asset at a predetermined price on a set future date. They are commonly used for commodities, currencies, and stock indexes. Futures can be used for hedging risk or for speculation. Options. Options are contracts that give the holder the right, but not the obligation, to buy or sell an asset at a specific price before or on a specific date. A call option gives the right to buy, while a put option gives the right to sell. Options are used for hedging, speculation, or generating income. ETF, exchange traded fund. An ETF is a collection of securities, such as stocks or bonds, that trades on an exchange like a single stock. ETFs can track a specific index, sector, commodity, or strategy. They can be passively managed, tracking an index, or actively managed. A manager decides which securities to include. IRA, Individual Retirement Account. An IRA is a type of tax-advantaged savings account for retirement. Contributions to an IRA may be tax-deductible, and investment growth is tax-deferred or tax-free, depending on the type of IRA. Liability. A liability is something that a person or business owes, usually money. Liabilities can include loans, accounts payable, mortgages, or any financial obligations. Penny stock. A penny stock is a low-price stock, usually trading for less than $5 per share. These are often issued by small companies and are considered highly speculative and risky because of low liquidity and high volatility. Market capitalization, market cap. Market cap is the total market value of a company's outstanding shares. It is calculated by multiplying the current share price by the total number of outstanding shares. Companies are often classified by market cap size: large cap, mid cap, and small cap. Leverage. Leverage involves using borrowed money to increase the potential return of an investment. While leverage can magnify profits, it also increases the risk of large losses because debts must be repaid regardless of investment performance. Balance sheet. A balance sheet is a financial statement that shows a company's assets, liabilities, and shareholders' equity at a specific point in time. It gives a snapshot of what the company owns, what it owes, and the net value for shareholders. Inflation. Inflation is the rate at which prices for goods and services rise, reducing the purchasing power of money over time. For example, if inflation is 3% per year, something that costs $100 today will cost $103 in a year. Liquidity trap. A liquidity trap occurs when interest rates are very low and savings rates are high, making monetary policy ineffective. People and businesses hoard cash instead of spending or investing, limiting economic growth despite cheap borrowing costs. Bid. The bid is the highest price a buyer is willing to pay for a stock. Ask. The ask is the lowest price a seller is willing to accept for a stock. Bid-ask spread. The bid-ask spread is the difference between the bid and ask prices. A narrow spread usually indicates high liquidity, while a wide spread suggests lower liquidity. Black swan. A black swan event is an unpredictable, rare, and high-impact event that can drastically affect financial markets, such as the 2008 financial crisis. Dead cat bounce. A dead cat bounce is a short-lived recovery in the price of a declining stock, followed by a continuation of the downward trend. Whales. Whales are investors or institutions with such large amounts of capital that their trades can significantly move market prices. Unicorn. A unicorn is a privately held startup company valued at $1 billion or more. To the moon. A slang term describing a stock or asset that rapidly and dramatically increases in price. Tanking. The opposite of to the moon, tanking refers to a stock or asset sharply dropping in value. Jigged out. This is slang for a situation in trading where the market moves into a position that forces you to close your trade at a loss, only for the market to later reverse into a position that would have given you a profit, or at least avoided a loss, if you had stayed in. It refers to being shaken out prematurely. Pump and dump. A pump and dump is a fraudulent market manipulation scheme. It involves artificially inflating, pumping, the price of a stock, often a low value or thinly traded one, through false or misleading positive statements. Once the price is high, the manipulators sell, dump, their holdings for a profit, causing the stock's price to collapse and leaving other investors with losses. Rug pull. A rug pull is a type of pump and dump common in small, new cryptocurrencies or tokens. The creators promote the coin heavily, attract investors, and then suddenly withdraw all liquidity or sell their holdings, causing the value to crash to near zero. Panic selling. Panic selling is a widespread, emotionally driven sell-off of stocks, sectors, or entire markets triggered by fear rather than logical analysis. As prices drop sharply, fear accelerates the selling, creating a self-reinforcing downward spiral. Stock exchanges sometimes halt trading during extreme panic selling to break the cycle. Shorting, short selling. Short selling is an investment strategy that profits from a decline in a stock's price. An investor borrows shares from a broker and immediately sells them, aiming to repurchase them later at a lower price. If the price drops, the investor buys them back at the lower price, returns them to the lender, and keeps the difference. The risk is theoretically unlimited because stock prices can rise indefinitely. Short squeeze. A short squeeze occurs when a heavily shorted stock's price unexpectedly rises sharply. Short sellers are forced to close their positions by buying back shares to limit losses. This extra buying pushes the stock price even higher, intensifying the squeeze. Limit order. A limit order is an instruction to buy or sell a stock at a specified price or better. A buy limit order executes only at the limit price or lower. A sell limit order executes only at the limit price or higher. Stop loss order. A stop loss order is placed to automatically buy or sell a stock once it reaches a certain price, limiting potential losses on a position. Trailing stop order. A trailing stop order is a stop loss order set at a fixed percentage or dollar amount below the market price, which automatically moves up as the stock price rises. It allows investors to lock in gains while protecting against downside risk. Fill or kill (FOK) order. A fill or kill order must be executed immediately in its entirety or canceled. It is used when an investor wants to avoid partial fills. All or none order. An all or none order must be fully executed or not at all. It ensures that the investor gets the total number of shares they want in a single transaction. Long squeeze. A long squeeze is the reverse of a short squeeze. It occurs when investors holding long positions, expecting the stock to rise, are pressured to sell due to falling prices. This can be triggered by multiple stop-loss orders and panic selling, causing the price to fall further. Market order. A market order instructs a broker to buy or sell a stock immediately at the best available current price. It guarantees execution, but does not guarantee the exact price received. Good till canceled GTC order. A GTC order remains active until the trade is executed or the investor cancels it. It does not expire at the end of the trading day. Day order. A day order is an instruction to buy or sell a stock that expires at the end of the trading day if it is not filled. Averaging down. Averaging down is a strategy where an investor buys additional shares of a stock as its price falls, lowering the average purchase price of the total position. Fading. Fading is a trading approach where a trader deliberately goes against the prevailing market trend or sentiment, betting on a reversal. Hedge fund. A hedge fund is a pooled investment fund that uses diverse and often high-risk strategies to generate returns. Managed by professionals, hedge funds typically cater to wealthy individuals or institutional investors with high minimum investments and fewer regulatory restrictions compared to mutual funds. Mutual fund. A mutual fund pools money from many investors to purchase a diversified portfolio of stocks, bonds, or other securities. It is managed by professionals and gives smaller investors access to diversified investments. REIT, Real Estate Investment Trust. A REIT is a company that owns, operates, or finances income-producing real estate and trades on major exchanges like a stock. REITs are required to distribute at least 90% of taxable income to shareholders as dividends, making them popular for income-focused investors. American Depositary Receipt. An ADR is a certificate issued by a U.S. bank that represents shares in a foreign company. It allows U.S. investors to buy shares in non-U.S. companies without dealing with foreign exchanges. SPAC, Special Purpose Acquisition Company. A SPAC is a publicly traded shell company created to raise capital through an IPO with the purpose of acquiring an existing private company. SPACs allow private companies to go public without a traditional IPO process. Control stock. Control stock refers to shares owned by major shareholders, often company executives or large investors, whose holdings are large enough to influence or control company decisions. Holding company. A holding company exists primarily to own controlling stock in other companies called subsidiaries. It does not produce goods or services itself, but may oversee subsidiary management. Index fund. An index fund is a mutual fund or ETF designed to replicate the performance of a specific market index, such as the S&P 500. It offers broad market exposure and low operating costs. Day trading. Day trading is a high-speed strategy where traders buy and sell financial instruments within the same day, aiming to profit from short-term price fluctuations. Positions are closed before the market closes. Swing trading. Swing trading is a medium-term trading strategy where positions are held for days or weeks to profit from anticipated price swings. Intrinsic value. Intrinsic value is an estimate of the actual worth of an asset based on fundamentals such as cash flow, business model, and market conditions. It may differ from the current market price. Book value. Book value is the net value of a company's assets as recorded on its balance sheet, assets minus liabilities. It reflects the company's current net worth based on accounting data. Price to book, PB ratio. The PB ratio compares a company's market price to its book value per share. A lower PB may suggest undervaluation. A higher PB may indicate overvaluation. Value investing. Value investing is a strategy where investors buy stocks they believe are undervalued based on fundamentals, expecting the market to correct the price over time. Growth investing. Growth investing focuses on companies expected to grow earnings at above-average rates. These companies may have higher valuations and reinvest profits into expansion rather than paying dividends. Earnings per share, EPS. EPS measures how much profit a company generates per share of stock, calculated by dividing net income by the number of outstanding common shares. Technical analysis. Technical analysis is a method of evaluating securities by studying price charts, trading volume, and statistical indicators to identify patterns or trends. It focuses on market behavior rather than a company's financial fundamentals, using tools like moving averages, candlestick patterns, and momentum indicators. Fundamental analysis. Fundamental analysis evaluates a company's intrinsic value by examining its financial statements, management quality, industry conditions, and economic factors. The goal is to determine whether a stock is overvalued or undervalued compared to its real worth. Efficient market hypothesis, EMH. The efficient market hypothesis suggests that stock prices already reflect all available information, meaning it is impossible to consistently achieve returns higher than the market average through stock picking or market timing. Supply and demand. Supply is the total quantity of a product or asset available for sale. Demand is how much people want to buy that product or asset. If demand is high and supply is low, prices tend to rise. If supply is high and demand is low, prices tend to fall. Insider trading. Insider trading is buying or selling a publicly traded company's stock using confidential, non-public information. Most insider trading is illegal, as it gives unfair advantages to those with privileged information. Ticker symbol. A ticker symbol is a unique series of letters assigned to a publicly traded company's stock for identification on exchanges. For example, Apple's ticker is AAPL, compound interest. Compound interest means earning interest not only on your original investment, but also on the interest it has already generated. Over time, this snowball effect can lead to exponential growth of invested funds. Profit margin. Profit margin measures how much of a company's revenue remains as profit after expenses. It is calculated as net profit divided by revenue times 100, expressed as a percentage. Dollar cost averaging, DCA. Dollar cost averaging is an investment strategy where a fixed amount of money is invested at regular intervals regardless of the asset's price. This reduces the impact of volatility by spreading out purchases over time. Return on investment, ROI. ROI measures the profitability of an investment. It is calculated as net profit divided by cost of investment times 100. A higher ROI indicates greater efficiency in generating profits from invested capital. Now that you understand the language of investing, you're ready for the next step, applying it. Check out the playlist linked right here for beginner investors starting to build their portfolios. And don't forget to subscribe, because smart investing starts with financial education.